So our first speaker, Dr. Carole Nakhle, expert in the field of energy economics. As energy expert, she is a regular contributor to Geopolitical Information Service and program advisor to the Washington-based International Tax and Investment Center. She is also a member of the Advisory Council of the Natural Resource Governance Institute. I call Dr. Carole Nakhle.
Good afternoon, ladies and gentlemen. It's a great pleasure to be in my home country talking about energy. I remember when I did my PhD back, I think, in 1999, many people were asking me whether I would find oil in my father's backyard. And I said, yes, one day. And hopefully in the coming years, we'll find not only oil, but also gas and change our local economy. What I want to cover with you today, I know this morning we talked a lot about gas, we talked about the region. I'm going to focus on oil, and I'm going to look at it from a global perspective. In particular, I'm going to focus on 2014 to start with, because 2014 was a very interesting year for the oil market and, of course, for the gas market by de facto. It created an imbalanced market, which is still continuing, and I'm going to show you how. And then we had another important change, which is a historical shift in OPEC strategy. And we saw many publications on OPEC versus the US shale producers in particular. But I'm going to dig deeper and show you another interesting aspect, which is changing dynamics within OPEC. And here you may want to let your imagination go and perhaps combine geopolitics with energy economics, which I'm going to focus on. And then finally, look at what does all this mean to potential newcomers like Lebanon. And again, I can tell you from now, from the beginning, I'm actually quite optimistic, despite the gloomy situation. Let's start, first of all, by looking at the very basic facts that distinguish 2014 from other years. If you look at what happened in 2014, we started by having an amazingly low demand growth compared to previous years, as you can see with this dip on the graph. Then combine that with a surprisingly strong supply growth. So that was the first basic thing I learned when I did my economic degree, that you look at the demand and supply. And in this case, there is a clear situation where the supply in the green line exceeds the demand in the orange line. And what was the outcome? So no conspiracy theory, nobody trying to kill somebody else, production or future. The result was simply a decline in the oil price. Now, human beings, I always argue that maybe for good things we have a short memory, but also we tend to forget what is the normal, what is not in a global oil market. So while we had this high price band between 2011 and 2014, and if you want an artificial and unusual stability of the oil market, we got used to that. I remember people talking about $80, $100 as being the norm. But actually, this was a very unusual situation. And with the drop to this low price band post-2015 or mid-2014 onwards, this is actually a more normal situation for the oil market, especially that you have volatility. And it was, as I said earlier, it is this time a supply story. A supply story where, again, it was no conspiracy theory. If you play with the numbers, if you look at the supply disruptions between 2011 and 2014, they were matched almost barrel per barrel by excess in supply coming from various places, particularly in North America. At some point, one of these two forces had to win. And of course, the increase in US shale production exceeded expectations, and it won the upper hand, and that's why we had the decline in the oil price. Now, we also saw, for the first time, an interesting shift in OPEC strategy. And here I took two quotes from the former Saudi oil minister, who was replaced only recently, comparing the position of Saudi Arabia and, by de facto, OPEC, because Saudi Arabia is the largest and most important producer within OPEC at the moment. They shifted from traditionally defending prices. So if you look at this quote, for instance, from 2012, where they said, our wish and hope is to stabilize the oil price and keep it around $100 for the average, as the average price. Then fast forward a couple of years, we saw last year a dramatic shift in the position where instead of defending oil prices, OPEC moved to defending its market share as it's clearly seen also from this quote from former Minister Al-Naimi, who said that it is not the role of Saudi Arabia or certain other OPEC nations to subsidize higher cost producers by ceding market share. So I would like to talk a little bit about this shift in strategy and talk about whether OPEC has been successful in really protecting its market share. Now, many people say that OPEC's main, or Saudi Arabia's main aim was to kill shale, and let's see if they succeeded. So if you look at shale production, while it was surprisingly resilient because it took much longer to come down than many people thought, it is actually finally coming down. So in this sense, the Saudi policy, or OPEC policy, if we can say, has been successful. But it's not just the shale that they were aiming to kill. Actually, it was expensive production in various places around the world, from the Arctic to many deepwater offshore areas. So you can see when you look at these severe cuts in capex, we can say that in this sense, the policy of OPEC and Saudi Arabia has been particularly successful. But what about this issue of market share? And this is where we have these interesting dynamics that are going to create an interesting scene, actually, for somebody like me with my background, but I think for the broader audience interested in geopolitics. Let's look at the market share. So it is true that the Saudis succeeded in stopping the rapid growth in shale and in the US gaining market share. As you can see on this graph here, we had this rapid increase in US market share, which then from mid-2015 onwards, it kind of declined, and it's maintaining gradually but surely. But look at the Saudi market share. You can see that it is steady, but it has not been reversed. It did not increase, and that is a big question mark on the future of Saudi oil production and the future of the oil market. So yes, we succeeded as one objective of stopping the rapid increase in US shale, but did the Saudis reverse their own market share? It's yet to be seen. Meanwhile, two things are happening, actually three things are happening within OPEC. First of all, look at the Iraqi and Iranian production. In 2015, Iraq experienced, actually recorded, the second fastest growth in production after the United States. And you can see how Iraq's production has increased rapidly. And for your info, Iraq's production is actually reflects the contribution that the private sector can do to a country like Iraq, a post-war country like Iraq. But we have to keep in mind the large reserves and the low cost of exploration and production of Iraq. But this is clearly a contribution of the private sector in Iraq. Now, Iran, as you know, we had these economic and sanctions that hit the energy sector. So for several years, Iran's exports were actually limited and production suffered a little bit. But you can see as soon as the sanctions were lifted, we saw an impressive, a surprisingly rapid increase that exceeded expectations in Iranian oil production. Then there is a third country which we tend to dismiss. That is Libya. I mean, Libya's production was quite impressive before they had the civil war, and it may well come back quite rapidly once we have stability in the country, as we saw with other countries. Now, if you take these three countries into consideration, of course, the two first countries I mentioned, Iraq and Iran, this is something that's already happening. Libya, I acknowledge, it is something with, again, a question mark, because it all depends on the political situation in the country. However, if you think about the expectations about the future market share of OPEC, this is taken from BP's World Energy Outlook about how the oil market supply is going to look like in the next years, in the coming years. You can see that for OPEC, BP expects the market share to remain 40%. So between now and 2035, we're talking about an important organization which is going to supply 40%. But the big question is, who within OPEC is going to supply the biggest share of that 40%. So on the one hand, we have a steady market share for Saudi Arabia, and a rapidly increasing market share from both Iran and Iraq, and a big question mark on Libya. So this is an interesting dynamic that I said I would like you to keep in mind when we think about the oil market and its links with geopolitics, and perhaps we can discuss that in the Q&A. Now, what does all that mean to newcomers? As I said earlier, I'm optimistic, and there's always a light at the end of the tunnel. We talk about the oil price collapsing, but we forget an important element of the equation, that is cost. And there is a general rule in the oil and gas industry is that costs follow prices with a time lag of 6 to 9 months, which means that when we had rapid escalation in the oil price, guess what? We also saw a rapid escalation of cost. I recall the CEO of Chevron, I think in 2013, when the oil price was around 100, he said $100 a barrel oil price is equivalent to $20 or $30 per barrel for us, because cost increased quite rapidly and sometimes much faster than the oil price because the oil price was stable. So the good news today is that oil price is coming down or came down, and now the costs are adjusting and they are coming down as well. So it's not bad news. Don't be frightened by all these numbers about CapEx, capital expenditures cuts, because this also can be partly because of the fact that the industry invested at record level before that year, and costs are coming downside of the inflation. Then it's not the first time that the oil price collapsed at such a rapid rate. We've been there before, and the industry has been around for more than a century, so it's known for its survivor skills in this kind of industry. But this is where I want to build up on what my colleagues in the previous sessions covered. As you can see, the oil price is a volatile, we're talking about a volatile commodity, a global market. So if you're going to build a fiscal regime which is going to be the main component for attracting investors, so if you are going to build a fiscal regime which simply chases the oil price, you are going to get too tired, let alone you're going to impose on yourself a huge administrative burden, let alone you're going to forget that costs adjust as well. So the best thing to do is to build fiscal regimes which are internationally, not just regionally, internationally competitive, as previous speakers said, and again, avoid chasing the oil price. So what is my main take from looking at this, a quick look of this global oil fundamentals? If we look at the fundamental first on the demand and supply, you look at international organizations' publications such as the IEA, they said market is on course to be balanced, which means that because the supply is not growing as fast as it used to be and demand is increasing more than what it used to be, then we're going to see the gap between supply and demand closing, and this explains partly the increase in the oil price that we saw recently. But keep in mind two things. The first one is that over the last few months and last year, we saw a record buildup of inventories, or if you want, oil in the warehouse, oil in storage. So it will take a time before the demand absorbs all this excess capacity. And second, on the supply side, I want to highlight one thing, which is shale. Shale is different from conventional oil in a sense. It's much more flexible in responding to oil prices. So with conventional, while we have to wait years to see the impact of the oil price on potential supplies, with shale, the response is quite quick. It is yet to be seen, but it's definitely much more flexible. Then I hear many people say that it's the end of OPEC. I heard that many times before, and that's why I took this beautiful quote from somebody I respect a lot, a leading professor of economics, late Morris Edelman. He said, back in 1995, nearly all OPEC nations are in debt, like today. Non-OPEC production grows, like today, but the cartel survives and the unstable market with it. I think we can feel comfortable applying this conclusion of 20 years ago to the situation today. However, as I said earlier, interesting dynamics. If you look at the Saudi Deputy Crown Prince Mohammed bin Salman, who made the following statement in an interview given to Bloomberg just before the Doha meeting in last month, which many people described as a failure, I say not necessarily. He said, Saudi Arabia could raise crude output by more than 1 million barrels a day immediately if there was a demand for it. Why? If we wanted to, and we can. So that leaves us with question marks about whether the oil price has really bottomed up and whether we're going to see the 80 or the 90 or the hundreds anytime soon, or we should expect further volatility and even another bottom up. So that's why I took this beautiful slide from Bloomberg, where they tried to trace in a short period of time between January 14 and May 16, how many times we thought that the oil price reached the bottom, but it did not. It surprised us and reached another low again. And because our experience in terms of predicting the oil price is rather poor, and I can speak this on behalf of many of my colleagues, the economists, we use very sophisticated models to try to predict the oil price, and unfortunately, we always get it wrong. When we get it right, it's pure luck or chance. And that's why when I joke with my colleagues, I tell them, if you want to know where the oil price is heading, and I hope you don't ask me this question, I say, let's go back to the basics of Lebanon and ask Tandrenma for help. Perhaps she can give us more insights with the coffee reading. Thank you very much.